Hello, I'm Katie St. Ors, certified financial planner, tax strategist, and producer of The Deep Dive. Welcome to Season 3, Episode 43, and today we will do a deep dive into the corporate earnings season. Okay, it looks like Elizabeth and Michael are chomping at the bit, so let's get going.
Hello and welcome. Today, we're diving deep into a really crucial time for the financial markets, earnings season. Think of this as your personalized cheat sheet for understanding all the buzz.
That's right. We've gathered a whole load of key information on this topic, and we've distilled it down for you. Our goal today is pretty simple. Help you understand why these quarterly reports are so important and, how they can actually move the stock market.
Exactly. Think of it like your shortcut to getting informed, cutting through the noise, the data overload, and just focusing on what really counts.
Yeah, and the sources we've looked at will help us tackle some big questions, like what are these reports exactly?
And why do analysts carry so much weight? Their expectations seem critical.
They really are.
Yeah.
And also, how do markets react to the news? Good news, bad news? What typically happens?
So get ready. We're going to unpack the mysteries of earnings season and figure out how this information can be relevant to you, really no matter your level of financial experience.
Okay, let's jump in.
All right, first things first. What on earth is an earnings report?
Okay, so essentially an earnings report, sometimes people just call it the results. It's a formal public statement. A company that's publicly traded puts it out, and it details their financial results over a specific period.
Usually a quarter, right? 3 months.
Usually, yeah. Most often it's for a fiscal quarter, 3 months. But you also get more comprehensive annual reports too.
So it's kind of like the company's quarterly report card.
That's a perfect analogy, actually. Think of it as the official report card, grading their financial and operational performance. And these reports, they serve a few key purposes.
Okay.
Mainly, it's about promoting transparency, giving shareholders, potential investors, the public, giving them crucial info on how the company's actually doing.
And I gather this transparency isn't just like good manners. It's often required, isn't it?
Oh, absolutely. It's often a regulatory requirement.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
In the U.S., for example, the SEC, the Securities and Exchange Commission, mandates that public companies file quarterly reports. That's the Form 10-Q.
10-Q, right.
And annual reports, the Form 10-K. So there's a minimum standard for what they have to disclose.
Okay, so the 10-Q is the quarterly snapshot, and the 10-K is the big annual deep dive.
You got it. And the information in these reports, it's absolutely vital for decision-making. Investors use it to gauge the company's value, its prospects.
Yeah.
Management uses it for strategic planning, figuring out where to go next. Even competitors watch these reports to analyze the market.
And that quarterly frequency, it kind of sets a predictable rhythm for the market, doesn't it?
It really does. That quarterly frequency creates this predictable beat. You know when these periods are coming, when significant new information is going to drop for lots of companies.
Right.
And this rhythm, it influences analysts. They often update their research around these releases. It impacts portfolio managers who might adjust their holdings beforehand or react quickly after. And the media coverage, well, it definitely ramps up during earnings season, becomes a real focal point.
Okay, so we have these reports chock full of numbers. Which ones are the real headliners? The ones we absolutely need to keep an eye on?
Yeah, great question. While the reports have tons of info, the market often zooms in, like really intensely, on a few key metrics. These give you that quick snapshot of performance.
Okay.
First up, you've got revenue, sometimes called the top line.
What by top line?
Because literally, it sits at the top of the income statement. It's the total amount of money the company brought in from its main business activities, usually selling goods or services during that reporting period.
So it shows demand, the scale of the business.
Exactly. It indicates overall demand for what they offer and the sheer size of their operations. Steady revenue growth. That's generally seen as a positive sign.
Okay, revenue first. What's next?
Then you get net income, also known as the bottom line or profit.
Makes sense. It's at the bottom of the income statement. What does that tell us?
Well, after you account for all the costs of doing business, things like operating expenses, salaries, rent, the cost of goods sold, interest payments on debt, taxes, you name it, what's left over from the revenue, that's the net income.
The actual profit.
The actual profit for the period, yeah. It's a super crucial indicator of whether the company's managing its expenses effectively and, generating sustainable earnings.
And then there's the famous one, EPS, earnings per share. Why is that number so closely watched?
EPS is maybe the most scrutinized metric of all.
Yeah.
What it does is translate that net income figure into a per-share number.
How's it calculated?
You take the net income after you subtract any dividends paid out to preferred shareholders, and you divide it by the average number of common shares outstanding during that period.
Okay.
So EPS gives you the standardized way to look at profitability on a per-share basis. Makes it much easier to compare a company's performance over time and also against its competitors. It directly shows how much profit is being generated for each unit of ownership held by common stockholders.
But you mentioned earlier that just looking at EPS alone can be a bit misleading. Why is that?
Yeah, that's a really important point. How the EPS growth is achieved tells you a lot about the company's underlying health.
Okay.
Strong EPS growth driven by solid increases in revenue. The top line, that's generally the best signal. It points to healthy demand, maybe some good operating leverage.
Makes sense. More sales leading to more profit per share.
Right.
Right.
But a company could also boost its EPS by aggressively cutting costs, even while revenue stays flat or maybe even declines. Now, cost cutting can reflect efficiency gains, which is good, but it could also be masking underlying weakness in demand, or maybe those cuts aren't sustainable long term.
Or just papering over cracks.
Sort of. And another way companies can increase EPS is through stock buybacks. They buy back their own shares, reducing the number outstanding, which mathematically pushes up EPS. But that doesn't necessarily reflect any improvement in the actual business operations.
So it's financial engineering, not necessarily better business performance.
Exactly. So analyzing the source of the change in EPS is revenue growth, efficiency, cost cuts, or financial engineering. That's crucial for understanding the quality of those earnings.
Got it. Growing EPS from higher sales is strong. If it's just cost cuts or buybacks, you need to dig deeper.
Precisely. That's the key takeaway there.
Okay, this is where it gets really interesting, I think. We talk about these reported numbers, but it feels like the market pays just as much, maybe more attention to what analysts expect. Why are these expectations such a big deal?
You've hit on something absolutely central. In the world of earnings reports, context is everything. The actual financial numbers a company releases, they're rarely judged in isolation.
Okay.
Instead, they're almost always compared against a benchmark. The analyst expectations are consensus estimates.
Right, the consensus. What is that exactly?
So these expectations, they represent the collective forecast of professional financial analysts. These are people who specialize in covering a specific company or industry.
Working for investment banks, research firms.
Typically, yeah. Investment banks, brokerage firms, independent research outfits, they do deep dives into companies, they build financial models, they talk to company management, analyze industry trends, and then they publish research reports.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
And those reports include their predictions for key metrics, like revenue and EPS, for upcoming quarters.
So how do all these individual predictions become one consensus?
Good question. Financial data providers, big names like Bloomberg, Refinitiv, GIP, they aggregate all these individual forecasts from numerous analysts. Then they calculate an average or consensus estimate.
And this consensus number is really important.
Hugely important. You really can't overstate it. It effectively sets the bar for a company's performance. The stock market, which is always looking forward and driven by expectations,
Right.
it often reacts more strongly to how a company's results compare to these estimates than to the absolute value of the results themselves.
So the question becomes, did they beat the experts' guess or did they fall short?
Exactly. That comparison, beat or miss, becomes the main narrative driving the immediate stock price reaction.
It's like the market had a pre-game score prediction, and the reaction depends entirely on whether the actual score is higher or lower.
That's a great way to put it. The existence of these widely publicized consensus figures creates this powerful psychological anchor for the market.
An anchor. Interesting.
Yeah. When a company reports its actual numbers, the deviation from that anchor, the beat or the miss, tends to trigger a much sharper reaction than if there were no explicit benchmark. It provides a clear measure of surprise.
And the size of the beat or miss matters too, presumably.
Oh, definitely. The magnitude is critical. A company reporting, say, $1.10's EPS versus a $1 estimate, a 10-cent beat, will likely see a different reaction than if they reported $1 or 1 cent, just a 1-cent beat.
Right. Bigger surprise, bigger reaction usually.
Usually. And the company's track record matters too. A company that consistently beats estimates might need an even bigger beat to really impress the market,
Okay.
whereas one with a history of misses might get punished more severely for another shortfall, or maybe rewarded more generously if they finally manage to beat expectations.
So history plays a part in how the surprise is received.
It does. That element of surprise, measured against the consensus anchor, is a key driver of the post-earnings price movement. Essentially, the market cares as much about how the company did relative to expectations as it does about what they actually earned.
Okay, so based on that comparison, beat, miss, or maybe just meeting expectations, how does the market typically react? Are there common patterns we see?
Yeah, generally based on how the actual reported results stack up against those analyst consensus estimates, the outcome usually falls into one of three buckets, and each one has a pretty common short-term stock price reaction associated with it.
Okay, bucket number one.
First, you have the earnings beat, or beating expectations. This happens when a company reports financial numbers, especially revenue and yield or EPS, that are higher than the consensus estimates. They did better than the market anticipated.
And the reaction.
The typical short-term reaction is usually a jump in the company's stock price. Investors react positively to the better-than-expected performance.
Makes sense. And the flip side, when things don't go so well, that's the earnings miss.
Correct. An earnings miss, or missing expectations, is when the reported numbers fall short of the consensus estimates. The company underperformed what was expected.
And the stock price.
Typically takes a hit. The usual short-term reaction is a decrease in the stock price, reflecting the market's disappointment.
Okay, beat means up, miss means down, generally. What about the third option, meeting expectations?
Right, meeting expectations. This describes the situation where the company's reported figures are pretty much in line with the consensus estimates. They did about what everyone thought they would.
So what happens then? Is it just flat?
The reaction here can be more mixed or kind of muted. Sometimes, if a positive result was widely expected and maybe already baked into the stock price before the announcement.
The buy the rumor, sell the news idea.
Exactly that. The stock might actually drift down slightly, even though they met expectations. In other cases, just meeting estimates might be seen positively, especially if there were underlying fears about a potential miss. That could lead to a modest price bump.
So it depends a bit on the mood beforehand.
It does, and crucially, in this meeting expectations scenario, the company's forward guidance, what they say about the future, often becomes the deciding factor for where the stock goes next.
Okay, so just to sum that up, beat, usually positive, miss, usually negative, and meet. It depends, and guidance becomes really important.
You nailed it. That's the general framework.
So this brings us neatly to that point. It's not just about the past numbers, but what the company says about the future. How powerful is this forward guidance?
Immensely powerful. While the past performance reported in the earnings is important, you have to remember the stock market is fundamentally a forward-looking mechanism.
Right, it's always trying to price in the future.
Exactly. Investors are primarily concerned with the company's future earnings potential. And that's why the forward guidance provided by company management, alongside the earnings release, often carries even more weight in determining the stock's reaction than the historical results themselves.
So what exactly is forward guidance? What form does it take?
Forward guidance refers to the projections and outlook that a company's management team provides for upcoming financial periods. This could include specific forecasts for expected revenue, profit margins, or EPS for the next quarter, or maybe the full fiscal year.
Okay, hard numbers sometimes.
Sometimes. Or it might involve more qualitative statements talking about anticipated business trends, market conditions, planned investments, strategic initiatives, that sort of thing.
And where do we find this guidance?
It's typically included right in the earnings press release, and then it gets elaborated on, often in detail, during the earnings call.
Ah, yes, the earnings call, that conference call they do.
That's the one. It's a conference call, often webcast these days, held shortly after the release. The executives discuss the results, the outlook, and crucially, they take questions from analysts and institutional investors. That Q&A can be very revealing.
So a company could actually report a great quarter, beat expectations, but if their guidance for the next quarter is weak, the stock could still fall.
Absolutely. That happens all the time. The importance of guidance comes directly from the market's forward-looking nature. A company might report earnings and revenue that crushed analyst estimates for the past quarter.
Sounds great so far.
But if their guidance for the future is weaker than expected, the stock price can still drop significantly. The disappointing outlook overshadows the past success.
Wow, okay.
And conversely, a company might miss estimates for the reported quarter, but if they provide strong, optimistic guidance for the future, their stock price could actually rally.
So investors might forgive a past stumble if the future looks brighter than expected.
Precisely. They might be willing to look past it. And the commentary, the tone during that earnings call adds vital context. How confidently does management present the guidance? How do they address challenges? What details emerge during the Q&A?
The qualitative stuff matters too.
Hugely. This qualitative info helps investors assess the credibility and realism of those forward-looking statements. Because, look, the market doesn't just take all guidance at face value.
Right. Management credibility must play a role.
A massive role. The management team's credibility, built on their track record of past guidance accuracy and transparency, is critical. If a team has a history of overpromising and underdelivering, the market might heavily discount even positive-sounding new guidance. But conversely, a team known for consistently meeting or beating their forecasts, their guidance is likely taken much more seriously, leading to more significant market reactions.
So guidance is management's attempt to shape expectations filtered through their credibility.
That's a great summary. Future outlook often trumps past performance in the market's immediate reaction.
It's clear there's so much more going on than just the headline numbers. What other, maybe less obvious factors do savvy investors dig into beyond the basic beat or miss?
Right. While that headline EPS and revenue comparison often drives the knee-jerk market reaction, sophisticated investors and analysts definitely dig deeper. They consider a whole range of other factors that influence how a stock performs after earnings. The story is usually more complex.
Okay, like what?
A key one is the quality of earnings. Not all profit is created equal,
What makes earnings high quality versus low quality?
Investors scrutinize how those earnings were generated. Were the strong results driven by sustainable improvements in the core business operations? Or were they maybe artificially inflated by one-off events like selling an asset, getting a favorable tax adjustment, or maybe using aggressive accounting practices?
Okay.
High-quality earnings come from repeatable operational success. Low-quality earnings might mask underlying problems or just aren't sustainable.
Got it. Sustainability is key. What else?
Another big one is revenue growth trends. A single quarter's revenue figure is less informative than the underlying trend. Is the company's revenue growth accelerating? That suggests growing momentum. Is it stable? Or is it decelerating, which could signal market saturation, increased competition, or maybe falling demand?
So the direction of travel matters more than a single data point.
Often, yes. The direction and the rate of change in revenue growth tell a much richer story.
And profit margins must be important too, right?
Absolutely. Analyzing profit margins like gross margin, which is profit after direct costs of goods sold, and operating margin, profit after operating expenses, reveals insights into efficiency and pricing power.
Expanding margins good, shrinking margins bad?
Yeah.
Generally.
Generally, yeah. Expanding margins suggest the company is controlling costs effectively, or maybe has the power to raise prices, both positive signs. Shrinking margins, though, could point to rising cost pressures, maybe increased competition forcing price cuts, or operational inefficiencies.
Okay. Quality, revenue trends, margins. What else?
Well, as we touched on with guidance, the management commentary and tone during the earnings call are critical. Specific details about operational challenges, new product pipelines, the competitive landscape, strategic shifts, plus the overall level of confidence projected by the executives. That provides invaluable qualitative context that the raw numbers just can't capture.
The human element, the narrative.
Exactly. And finally, you can't ignore the broader macroeconomic environment. A company's results are released into a specific economic context.
Right, it doesn't happen in a vacuum.
Not at all. Factors like rising interest rates, high inflation, recession fears, geopolitical events, or just overall market sentiment. These can significantly influence how earnings news is received. A stellar earnings report might only get a muted positive reaction if it comes out during a broad market downturn driven by macro fears.
So even great company news can get drowned out by bad economic news.
It can. And conversely, a disappointing report might be punished less severely if the entire industry is facing headwinds, suggesting the problem isn't entirely company-specific. The stock reaction reflects an assessment of the company's performance relative to this wider backdrop.
So it's this interplay between the company specifics and the macro climate.
Precisely. That interaction creates the complex, sometimes seemingly contradictory market reactions you see during earnings season. Investors are constantly weighing the micro performance against the macro risks and opportunities. So beyond the headlines, the quality and sustainability of earnings are absolutely crucial.
One thing I always notice during earnings season is how much more volatile stocks seem to become. Why does that happen?
Yeah, that's one of the most consistent features of earnings announcements, the tendency for increased stock volatility.
Right before and right after the news comes out.
Exactly. In the days leading up to and immediately following a company's results release, its stock price is often subject to sharper, more frequent up and down swings compared to normal trading periods.
Why is that? What drives it?
Several factors contribute to this heightened volatility. Before the announcement, there's a buildup of uncertainty. Investors, traders, they're anticipating the news, speculating on the outcome. That anticipation itself can lead to more trading activity and price fluctuations.
Okay, the pre-announcement jitters.
Yeah. Then the earnings release itself delivers this huge dump of new information onto the market all at once. It confirms or refutes expectations about past performance, and crucially, provides that new guidance about the future.
So a lot for the market to digest quickly.
A ton. This concentrated information flow forces the market to rapidly reevaluate the stock's value, leading to potentially significant and swift price adjustments.
And more people trading, too.
Usually, yes. This period typically sees a spike in trading volume as investors react to the news, establishing new positions, adding to existing ones, cutting losses. High volume can facilitate bigger price swings.
And what about options? Do they play a role?
They definitely do. The options market sees significantly heightened activity around earnings dates. Traders buy and sell calls and puts to speculate on or hedge against potential price moves.
Yeah.
And this options activity, plus the hedging strategies used by market makers who sell these options, can actually further amplify the underlying stock's volatility. It's a feedback loop sometimes.
So it's a well-known phenomenon, this earnings volatility.
Oh, absolutely. It's a well-documented market pattern. It presents opportunities for short-term traders and options strategists who are set up to potentially profit from big price swings.
But for long-term investors.
For long-term investors holding through an earnings announcement, it also represents a period of heightened risk. You just need to understand that sharp, sometimes unexpected price moves are more likely during this time. So, bottom line, brace for choppiness. Earnings season is inherently volatile.
And the impact of one company's earnings report, is it usually just confined to that single company? Or can it spread?
Oh, it definitely spreads. The impact of an earnings announcement often ripples well beyond just the company releasing the report. It can create knock-on effects across its entire sector and sometimes even influence the broader market sentiment.
How does that work? Like if a big tech company reports good news?
Exactly. The earnings reports from large, influential companies, often called bellwethers or leaders within a particular sector, are watched closely not just for their own performance, but as indicators for the health of the whole industry.
So good news from one can lift others.
Yeah. Strong results and an upbeat outlook from a major tech firm, for instance, might boost the stock prices of its competitors, its suppliers, even some of its customers. Investors infer positive trends for the entire tech ecosystem.
And the reverse is true, too. Bad news can drag others down.
Absolutely. A weak report from a leading bank could pull down other financial stocks. Poor results from a major retailer might raise concerns about consumer spending, hitting other retail and consumer goods companies.
It's like a contagion effect.
That's a good term for it, yeah, a contagion effect. It happens because companies within the same sector often face similar market conditions, customer demand trends, supply chain dynamics.
Right, they're in the same boat to some extent.
Exactly. So the performance of a leader provides valuable, though obviously imperfect, clues about the operating environment for its peers.
And can enough of these reports actually sway the whole market?
Yes, they can. The collective results from several key companies, especially market leaders across different sectors, can significantly shape overall market sentiment. A wave of positive earnings surprises and strong guidance can boost investor confidence and contribute to a market rally.
And a string of misses.
Conversely, a series of high-profile misses and cautious outlooks can dampen sentiment and lead to broader market declines. The interconnectedness of the modern economy through complex supply chains, competitive landscapes, means that the performance reported by one major entity transmits information, positive or negative, to related companies.
Yeah.
That drives these wider sector and market moves during the peak of earnings season.
So one big company's report really can move an entire sector. That's powerful.
It really is.
Okay, so just to wrap things up then, earnings season is clearly way more than just a bunch of numbers being released.
Absolutely. Earnings reports are a fundamental piece of the stock market landscape. They're these periodic, formalized checkups on the financial health and operating performance of public companies.
And while the reports themselves are dense, the market's reaction often hinges on a few key dynamics.
That's right. Performance isn't judged in isolation, but critically against that benchmark of analyst consensus expectations leading to those beat, miss, or meet outcomes.
And crucially, the market's always looking ahead.
Always. So while past performance matters, that forward guidance from management about future prospects often exerts an even more powerful influence on the stock price. Good guidance can save a stock after a weak quarter. Cautious guidance can undermine strong historical results.
And beyond those headline comparisons and forecasts, smart investors are digging into the quality of earnings, revenue trends, margins, and the nuances from management on the earnings call.
Exactly. And this all happens within the context of the wider macro environment, which can amplify or mute the impact of company-specific news.
And we definitely need to be ready for that increased volatility around announcement dates.
Investors should anticipate and be prepared for heightened stock price volatility around earnings announcements driven by uncertainty, the concentrated info flow, and increased trading.
And remember that the impact isn't isolated. Reports from influential companies can ripple through entire sectors and shape overall market mood.
Right. Ultimately, earnings announcements serve as this vital mechanism for price discovery. They force these periodic reality checks, testing the market's prevailing narratives and expectations against hard data from the companies themselves.
And the price movements that follow just reflect the market rapidly incorporating all that new information.
Exactly. Helping to ensure that over time stock prices more accurately reflect companies' underlying fundamentals and future prospects. Understanding these dynamics, the metrics, the expectations game, the power of guidance, the deeper factors, the potential for volatility and ripple effects, it's crucial for anyone looking to interpret market moves during earnings season and appreciate that constant flow of information shaping the financial markets.
So earnings season, a key window into the financial pulse of companies.
Couldn't have said it better myself.
So thinking about all this, what other factors do you think might influence how the market reacts to earnings reports? We invite you to mull that over and keep exploring this really fascinating aspect of the financial world.
Absolutely.
Thanks for joining us for this deep dive.
It's been a pleasure.
We'll see you next time.
See you later.
Okay, great. That's a wrap. I'm Katie St. Ors, and let me send out a huge thank you for listening. If you want more content on personal finance and small business, head over and find me on YouTube. You can also find me on Spotify, Amazon Music, TikTok, and Apple iTunes. Thanks again for tuning in, and I'll catch you on the next Deep Dive podcast.